For this mid-quarter topic, we're going to talk about how currency exchange rates impact investment returns, specifically for stock funds investing in non-US companies. So the question, does the strength of the US dollar versus foreign currencies impact investment returns? And if so, why? Well, to answer the first question, the answer is yes. It does impact returns on investments that hold foreign company stock. This graphic does a pretty good job of explaining that. As far as when the US dollar declines in value against foreign currencies, it actually leads to stronger returns in those investments in foreign companies. So let's look specifically at the euro and what has happened over the last year. So on June 30th, 2024, in order to buy €1, you had to pay $1.07 in US currency. 12 months later, it actually cost you $1.18 to buy €1. So it would be a clear example of the US dollar getting weaker against the euro by 10%. Now let's look specifically at an investment fund that invests in European stocks. So we are going to look at, again, June 30th of 2024 versus June 30th of 2025. So back on June 30th of 2024, you could buy one share of this fund, the SPDR Portfolio Europe ETF Fund, for $40.71. If you were in Europe buying this fund, it would cost you 38.05 euros. And again, at that point, the exchange rate was $1.07 per euro. Now, looking at 2025, 12 months later, to buy one share of this fund, it would cost you $48.46 US currency. If you're sitting in Europe and you're paying euros for an investment in this fund, it would cost you 41.07 euros. At this time, the exchange rate, as we noted earlier, is $1.18 US dollars per euro. So, depending on what currency you bought this fund in is going to significantly impact what percent of return or increase you earned over those 12 months. When you bought it in US dollars, you earn 19% on this fund. If you were sitting in Europe and you bought it in euros, you would only earn 8%. Now, the funds, the companies represented within this fund, they're in Europe, and so they transact using the euro. So 8% is a true representation of how this fund performed without any currency exchange involved. However, clearly 11% higher return for those of us sitting in the US who bought this fund in US dollars and would sell it in US dollars. Again, that is 8% return for the underlying companies and their stocks, but 11% return just because of the change in the exchange rate shown at the bottom. So that was a really quick topic, but I think it's interesting because it is something we are seeing in our portfolios this year, that foreign stock funds are doing extremely well, and so you may have been wondering why. And that's the reason. It's not only that the companies are doing well, but it's also the change in the exchange rate. So if you have any questions about this topic or your portfolio specifically, or you want to set up a time to meet and discuss other planning questions that you have, feel free to reach out to me by email, or my phone number is also shown there, and we'll set up a time to meet. Thank you.